This is the Retirement Cheat Code, and I'm JD White. Thank you for joining me today. Today, we're going to talk about pre-tax accounts, just what they are and how they function at a high level. I hope you learned something from today's video. Let's go ahead and hop into it. So the idea of a pre-tax account is that you're going to put money into this account and not pay taxes on it today. You're going to kick that can down the road and pay taxes on it later. What we're trying to accomplish when we do this is not only saving for the future, saving for retirement, but we're really focused on reducing our current tax bill. Again, hypothetical numbers, and they're not perfect. It doesn't quite work out this perfect in real life. But if you make $100,000 and you put $20,000 into the pre-tax portion of your 401k, on paper, when you file your return, you now have made $80,000. But when you pull that money out in retirement to live on, that money now all gets taxed as income. So if that $20,000 that you put in today is now worth $40,000 down the road, you pull out $40,000 to live on in retirement, you now have $40,000 on that tax return in the future as taxable income. So you're going to pay the IRS. You're going to pay them either now or you're going to pay them later. So that's the way that tax deferral works. The two accounts that you're probably most familiar with would be the 401k, which is actually just a specific provision in tax law that allows for employees to defer their salary. You're taking a portion of your salary and kicking it down the road. So that's what the 401k actually stands for. But all it is it's an employer sponsored plan that we're all really familiar with, that we put a portion of our paycheck into. The other one would be we call it the traditional IRA or individual retirement account. A lot of times it's just IRA, but in our world, traditional IRA helps us differentiate that between some of the other accounts like Roth IRA, Simple IRA, SEP IRA, which are different accounts. There's different rules. So those are the two big ones. You can also do Roth inside 401k. So I don't want that to be a catch-all, but typically when we're deferring taxes or putting money into the pre-tax bucket, we think of traditional IRA, 401k. There's also simple IRAs. There's SEP IRAs. Those two do not allow for Roth. There is 403bs, which is typically through schools or governments, and they do allow for Roth in a lot of them. There's 457 plans, which is typically also government workers, specifically firefighters. They typically allow for Roth as well. There is also 401as, which is hospitals, also allow for Roth. And then there's thrift savings plans, which are government workers, usually like post office, also allows for Roth. So there's a lot of different ways that you can put money into the pre-tax bucket and kick that can on the road. Typically what we're looking at is if you are in a higher tax bracket, we're going to try and put as much as we can into that bucket to kick that down the road, with the idea that we're going to be in a lower tax bracket when we retire. If you're in kind of the middle ranges of the tax brackets, 22, 24%, maybe there's a conversation that needs to happen around whether or not we want to put money into that bucket, or if there's other more favorable buckets that we can go into. We can pay our tax bill now, knowing that maybe it's not going to change in the future. So we can just pay off the IRS and then attempt to grow that money in a more tax efficient way. So that's the 30,000-foot view on pre-tax accounts. I will have more videos getting into the specifics of a lot of those accounts, if not all of those accounts, including some of the limits on the numbers, and we'll try and keep those current. So anyway, if you want to support this channel, the best thing you can do is click the subscribe button. And of course, I love it when you smash that like button. I appreciate your time as always, and we will catch you on the next one.